The stock market is currently closed, so let us look directly at where things stand. As of the closing bell on June 2, 2026, Microsoft Corp trades at exactly $441.29 per share, marking a significant intraday downward move of 3.61% during the Tuesday session. This clean drop occurred on an accelerating trading volume of over 37 million shares, slipping well below the previous session's close of $460.52. While the headlines point toward a broad tech pullback, the expectation among most retail investors using popular modern platforms like the Robinhood app or tracking major tech positions through SoFi Invest was that Microsoft would effortlessly glide through its annual Build developer conference. Instead, reality hit hard as a combination of multi-billion-dollar infrastructure spending fears and a fresh Federal Trade Commission antitrust investigation forced an abrupt valuation reset. This tension between what the public expects from a trillion-dollar software giant and the cold financial reality of modern cloud competition is exactly where the smart money separates from the crowd. When you track high-profile assets like Nvidia stock or Apple stock, the narrative is usually simple, focusing purely on consumer sales or chip shipments. But looking at Microsoft stock right now reveals a far more complex picture than what a casual glance on self-investing sites might suggest. The common ground among everyday investors is that Microsoft is the absolute untouchable leader in software, insulated from serious downturns by its enterprise dominance. The contrarian reality is that Microsoft has entered an incredibly capital-intensive phase where it must spend an unprecedented amount of capital just to stay in the exact same place. For anyone engaging in online investing without professional investment help, it is easy to assume that a massive company growing its revenue by 15% year over year is an automatic buy. However, a deeper look into the macro data reveals that the company is currently on track to spend approximately $190 billion in capital expenditures for the calendar year of 2026 alone. This massive cash outflow is being deployed to build out hyperscale data centers, secure specialized high-end graphics processors, and construct the fundamental physical architecture required for cloud computation. While institutional wealth management desks view this as a necessary defensive moat, the immediate impact is a visible squeeze on short-term free cash flow margins, a detail that is beginning to alarm conservative market participants. This massive scale of capital commitment changes the entire equation for individual brokerage accounts. On one side, you have prominent Wall Street analysts arguing that the market is severely mispricing Microsoft stock ahead of a major monetization wave. They point to corporate partnerships, like the recent multi-billion-dollar alliance with consulting giant EY to integrate enterprise software, alongside a skyrocketing annual run rate for cloud-based subscription services. On the other hand, the reality of a massive enterprise outage affecting their core cloud systems earlier in the week serves as a stark reminder that running these massive digital ecosystems carry real operational vulnerabilities. When corporate platforms go dark, even for a few hours, it directly shakes institutional confidence. This loss of momentum becomes clearly visible when analyzing trading volume patterns across major institutional corridors, where heavy block trades indicated a clear rotation out of software and back into raw semiconductor hardware during the midday dip. Let us pause for a second and look at how this fits into your broader portfolio strategy. Comment below how many shares of Microsoft stock you currently hold in your account, and let me know if you are buying this dip or moving your cash into other tech assets. If you look at the technical structure on a standard interactive brokers platform or check the charting indicators within the Fidelity mobile app, you can see that this 3.61% drop managed to slice right through short-term moving averages that had previously acted as firm support. Just a single session prior, Microsoft stock had experienced a powerful breakout that pushed the price up toward the $450 range, leading many technical traders to assume a full recovery toward the 52-week high of $555.45 was imminent. The reality of the regulatory headlines shattered that pattern completely. The Federal Trade Commission expanding its investigation into cloud services, software bundling, and restrictive licensing agreements introduces a layer of structural risk that mathematical chart patterns simply can't account for. Regulatory friction does not just mean potential fines. It threatens the very cross-selling model that allows Microsoft to maintain an incredibly high average revenue per user across its corporate client base. When a government agency begins auditing whether your software packaging practices artificially restrict competition, institutional compliance departments often pause their accumulation programs, removing a critical buying floor from the market. This specific type of regulatory pressure is precisely why modern asset allocation requires sophisticated tools. Many investors who utilize an automated hands-off approach through services like Schwab Intelligent Portfolios or a basic SoFi robo-advisor are often unaware of how heavily weighted their total net worth is toward just 2 or 3 mega-cap tech stocks.
If you are managing your own individual brokerage account via Interactive Brokers Trading, you have to look past the surface-level marketing of these systems. For instance, while younger retail investors on the Robinhood app might focus entirely on fractional shares and daily price momentum, seasoned market veterans are digging into the underlying corporate filings. Over the last 3 months, internal corporate insiders at Microsoft have offloaded roughly $5.6 million worth of shares. While that dollar amount is relatively small compared to a multi-trillion-dollar market capitalization, the timing of these insider sales right before a massive capital expenditure ramp-up indicates that management understands the near-term margin pressures the business faces. To truly understand why the stock is reacting this way today, we have to look closely at the underlying business model that built this giant. At its core, Microsoft operates 3 primary business divisions: Productivity and Business Processes, which handles legacy Office software and corporate networking platforms; Intelligent Cloud, which encompasses the massive Azure infrastructure; and More Personal Computing, which handles consumer electronics, gaming ecosystems, and operating system licensing. For decades, the legacy software business acted as an incredible cash cow, producing high-margin recurring revenue that required minimal capital reinvestment. This massive pool of predictable cash allowed the firm to easily fund dividends and execute massive share buybacks. However, the modern reality of competitive online investing has forced a massive structural shift. The core growth engine is now entirely centered around the Intelligent Cloud, a business segment that requires an endless stream of real-world infrastructure investments. Unlike software code, which can be duplicated infinitely for near-zero cost, building and maintaining global networks requires purchasing physical real estate, securing massive amounts of electricity, and continuously buying short-lived server hardware that depreciates rapidly. This fundamental transformation from a pure high-margin software business into a heavy infrastructure enterprise is what causes the disconnect between general investor expectations and institutional reality. When retail traders look at popular investing sites or research Fidelity mutual funds, they often see backward-looking metrics like a trailing price-to-earnings ratio or historical return on equity. These figures look incredibly healthy because they reflect the massive profitability of past software cycles. The forward-looking reality, however, is that return on invested capital is facing downward pressure because the denominator, the total amount of cash tied up in physical data centers, is expanding at a much faster rate than immediate net income. This trend is exactly what sophisticated portfolio managers analyze when building positions within specialized tech-focused Fidelity ETFs or managing long-term Fidelity wealth management accounts. They are looking at the efficiency of each dollar spent, and right now the market is demanding proof that these multi-billion-dollar data center investments will actually generate a tangible return in the upcoming fiscal quarters. Looking ahead, the trajectory of Microsoft stock will likely be determined by 2 competing forces. The immediate catalyst to watch is the upcoming dividend distribution scheduled for June 11, 2026, where the company will return 91 cents per share to investors. This regular payout typically creates a reliable institutional buying floor in the days leading up to the record date, as dividend-focused mutual funds and index trackers adjust their holdings. However, this predictable cash flow could easily be overwhelmed by broader macroeconomic shifts, such as upcoming manufacturing data or interest rate decisions that heavily influence high-valuation growth sectors. If long-term interest rates remain elevated, the present value of cloud earnings drops, naturally compressing the price-to-earnings multiple that investors are willing to pay for mega-cap software companies. Conversely, if corporate adoption of integrated digital assistants accelerates faster than the current consensus estimates, the cloud division could see a massive surge in high-margin utilization rates, vindicating the aggressive infrastructure spending strategy. When you weigh these factors inside a diversified trading platform, the contrast between sentiment and mathematical reality becomes your primary guide. The general market expectation is that Microsoft is a safe haven asset that can be blindly held forever without close monitoring. The deeper analytical reality reveals an enterprise navigating a high-stakes corporate transition, facing intense regulatory scrutiny from federal regulators, and burning through tens of billions of dollars each quarter to defend its digital footprint against aggressive global competitors. This does not mean the long-term investment thesis is broken, but it does mean the era of effortless, straight-line stock appreciation has faced a necessary collection. True portfolio success requires moving past casual stock tips and looking at real operational data. By understanding the deep financial trade-offs between immediate cash flow and long-term infrastructure moats, you position yourself to make deliberate, rational decisions on individual brokerage platforms rather than simply reacting to the volatile daily swings of the broader market.